NEOS, one of the fan favorite ETF providers, has just introduced some new funds, the NEO boosted ETFs. Strategic expansion or a risky mistake? They're targeting a 19 to 23% annualized distributions after fees. Good thing, bad thing? We're going to cover it today. The controversy mix from investor reactions. Investor concerns is departure from NEOS's NAV stability principle. We've come to rely on NEOS as a very stable principal funds. They're also concerned about the increased risk profile with synthetic leverage and the potential for greater NAV volatility. And the shift from conservative to an aggressive strategy has got people questioning, is NEOS still the NEOS that we're used to? Especially when we see the news coming out that the end of leverage funds, that Defiance ETFs were liquidated. Many of you had those funds. I know you've talked to me about that, and you've come back now that they've been liquidated. Is NEOS going down the right path, the wrong path? Where are they heading? Some express concerns over the increased risk profile, and particularly the use of that synthetic leverage and that potential NAV volatility has been a huge factor in just real quick that this thing hasn't even been out yet, and they're already really concerned. But the support for enhanced income, the access to higher yields and for more aggressive investors, logically extension of the NEOS options-based income model, and maintains the commitment to the tax efficiency that it's focused on. The strict shift is a broadened investor base. So you're taking actually the three strongest funds that they've had, and you're adding this to a leverage base and coming up with the three new funds. Now, of course, these will all launch in February 3rd of 2026. So we have no more information other than what the prospectus says and what NEOS has come out and kind of doing a big push already, trying to get excitement behind it. And we've talked to people already, and others view the move as a very logical extension of NEOS's proven option-based income model. So it's a teeter-totter here. Which way are you on? Are you against leverage? Are you for leverage? Do you support NEOS different than you do Defiance or YieldMax or anyone else? Where does it all fall into? And this is what we're really kind of taking a look at. The NEOS proven track record is a tough one to beat. The NEOS core ETFs had demonstrated that consistent income generation and the NAV preservation across the market cycles. They've basically formed a foundation for the new boosted strategies. SPYI has total return 15.17, QQQI at 17.74, and BTCI at 58.11%. When you take away from that, you go to the distributions. These are income generators. Look at the income they'll generate, 12%, 14%, 26%. So the performance has been there. SPYI and QQQI delivers total returns that have just been, top of the market, top of what we talk about. And they are income focused. And even with all the Bitcoin issues and the decline in the Bitcoin and everything going on, BTCI has been there. They've really demonstrated that they're an income generating fund. So introducing the Boost series, and I guess we should have done this at the start just to tell you the true answer to it, is introducing the proper funds before we start questioning and talking about them. NEOS Investments launched 3 boosted exchange-traded funds representing a strategic expansion into higher yield leverage income products. XSPI, which is based off of the SPYI, the S&P 500 high income ETF, and it's using 1.5 synthetic leverage exposure to the S&P 500. They're trying to enhance that monthly income distribution. Then we have XQQI, which is the NASDAQ 100 high income ETF This is a synthetic 1.5 exposure to the NASDAQ 100. Again, higher yields through option premium income. And then XBCI is the Bitcoin high income ETF. Again, that 1.5 times exposure to the Bitcoin and trying to generate independence of its price of income. They're targeting that 19.23% annualized distributions after fees. Okay, so when you're taking a look at your adding in the expense fees and all that, you're realistically looking at between a 20 to 25% return. Now, those numbers are just forecasted. They are not guaranteed. They're in no way, shape, or form set up that, count onto it for that. They use a synthetic leverage instead of a traditional borrowing. And it maintains core principles of NAV stability and monthly income. The leverage proven options-based income model. So they're not using anything new and exciting and coming out because they're using a proven option-based income model that is just adding leverage to that base. They're maintaining the core principle of NAV stability and monthly income. So NEOS is saying they are going to continue doing what they're doing. They're just adding some leverage to it through the synthetic. Now, I said earlier this will release in February 3rd of 2026. And I'll tell you up front, we are going to watch this one like a hawk. We will do a few videos on this and just keeping you up to date. Now, no matter what happens, I'm following my personal rules that we do not invest in anything that's not more than 3 to 6 months old. So I'll be on the sidelines. I'll be sitting on the sidelines so I can really judge it properly and not worry about that I got money in the game. So we'll talk to you shortly here in February that we'll be saying, hey, this is what's going on. But come Tuesday morning, these things are going live and we'll be able to give you some update what's going on there. So take a look at the strategy, the deep dive, and how they're going to boost works with the funds. They're going to be purchasing NDX call options that provides the upside potential. And then they're also going to be selling NDX put options that will generate the premium income. So this is where they're getting their 1.5 times exposure through a synthetic long positions. So the leverage mechanism, the synthetic exposure via options combining with not traditional borrowing. So they're not going to be borrowing money onto anything. They're not going to be borrowing to create this. It's going to create a leverage position without marginal debt, which is a huge advantage across the board. The performance is driven from a net effect and derivative positions. They're still going to be using that tax efficiency that NEOS is well known for with that option classification of Section 1256 contracts, which gives you the 60 long-term and 40% short-term for capital gains, and favorable tax treatment versus ordinary income. So they got everything you're used to and welcomed into NEOS is going to be there, except for adding in this boost. So we look at the performance right now of the current funds. The SPYI, 15% total return, QQQI, 17% return, and BTCI, 58.11 total return. But when we look at distribution rates, 12, 14, and 26, this is what we're looking at. This is what we're going to try to boost. We're going to try to get about a 7 to 10% increase in the numbers. So my first question is, do we need additional 10 to 10% gross increase in these things? Do we need a 7% rise in SPYI? Do we need a 10% growth increase in QQQI? I'll leave it to you. How does that fit your portfolio? How does it fit your risk tolerances? How does it fit across the board? I turn and say for most retail investors and most retail retirees, I don't know if this is a piece of the puzzle that will really is really worth the risk. Now that's my own 2 cents opinion onto it. If I was a young investor, maybe yeah I could take that risk because I got time to recover. But being a retiree and being a person close to retiree, I don't know if they're going to be risk because what they do so well right now with these three funds, why mess with a machine that's already working really well just to get some additional yield? Because you got to remember, leverage will take you up and will take you down. So if SPYI takes a drop, you're going to see 1.5 times the drop that SPYI does. Same thing with QQQI and Bitcoin. So the risk and understanding is trade-offs. Higher potential returns increase risk. That leverage exposure amplifies both your gains and your losses. It's exactly what I was just talking about. If you're going to go up, everyone loves the boost up. Everyone hates the boost down. And you got to remember that because that is a big factor in leverage funds, boosting up versus boosting down. The synthetic leverage induces a counterpart of risk. There's bigger risk with that. The income sustainability, well, QQQI using that 99% return for return of capital and BTCI at 95. I'm telling you that's going to be a huge factor part of the mix. And the market volatility, they're going to be very sensitive to volatility strikes and spikes. And the written options become harder to manage. Now, we're not saying that NEOS can't handle it because it will be a managed fund. But the lack of performance and the lack of data that we have, because we really have nothing right now, are these going to be long-term viable pieces? We don't know. The prospect states that the performance information is not available yet, and the funds are subject to new fund risk. So I just want to be upfront with everybody and tell everyone that while we know NEOS has a deep experience with option management and reduces the likelihood of failure, the boost ETFs are inherently more volatile and risky than the company's existing offerings. So we're trying to make sure you understand the risk of all this. I'm not trying to be Debbie Downer, and I'm not trying to be Joe Positive. What I'm saying is you got to look at this open-minded. Is having the additional risk higher than having just the plain out standard portfolio? So I slipped back and started thinking about this and said, who's this target audience that would consider these things? Well, it's the risk-tolerant income seekers who are comfortable with 1.5 times synthetic leverage, seeking that 19 to 23% annualized distributions and focused on maximizing your potential. And I think my second one here is probably the biggest one I come with is that younger investor. Early in the career with the higher risk tolerances, seeking aggressive returns for growth and building investment income streams, this is dialed right into. You see a lot of people on YouTube and different stages of lives and doing the financials and talking different ways. And I really come back and say, guys, where are you at? You, the viewer, who are more important to you, the viewer. If you're young and so on, that yeah, you can take these risks. But if you're older like myself and into that retirement package, I don't know if the risk is really needed. Someone once told me, do you really need to swing at your age? Do you need to swing for home runs every time? Or aren't you happy with a couple singles and a couple doubles and you're still scoring? Income driven for investors, living off your investment income, seeking higher cash flow distributions, reinvesting the income for portfolio growth. Maybe a small part of your portfolio could be into these funds to help you try to grow your portfolio a little quicker. But you got to remember, leverage works both ways. So if you need a recovery, if you need maybe a little tune-up, a little fix on something, yeah, maybe you could use this. But I don't know if these are long-term set it, forget it type funds. I doubt that they will be. I think these are things you're going to see some playing around with that NAV side of it. But the boosted ETFs are not intended to replace any of the NEOS core high income funds, but rather serve as additional tools within the diversified portfolio. And I can't state that enough, that these are additional tools in the toolbox. You're not going to sell off SPYI and now buy the new leverage one. That's not right, especially in retirement funds. It's just another tool. If you need a little quick tune-up, you need a little boost in something, maybe that's why that name boost works so well, is that's where you want to head towards, that little extra boost in a portfolio. So market positioning and the tools, not replacements. Our core ETFs, SPYI, QQQI, BTCI, these are stable. I love how they changed the names already on these to minimum yield income with NAV stability. They used to call them high. Now they're using minimum. The new portfolio, integration, the boosted ETFs are designed to as tools within a diversified portfolio, not standalone solutions. Again, have to clarify that so clearly to everyone. Make sure you understand that these are not, switch everything over to them. They're not standalones. These are just pieces to help with what you already have. So the boosted funds, the XSPYI, the XQQI, and the XBCI, these are what they're going to classify. They're high yield, high risk income enhancements using that 1.5 leverage. Strategic fit, it's best suited for investors who already have that diversified portfolio. The risk allocation and portfolio enhancements. Again, I just explained how to use these and where to put them. And, this is not financial advice. This is like asking grandpa about something. This is about asking your parents about something. It's about just getting some additional insight of where it's at with people at different stages of their lives. And as I said again, I'll repeat it one more time. You keep your core. You use the boost products to help repair or fix a broken area, or if you need maybe a little more growth, you can put it in there. But you have to remember that risk factor of that leverage. So the competitive advantage in the option experience here is NEOS experience. It's decades of experience in the option-based strategies. It's a proven track record with the NAV stability across market cycles, and it's that income generation even during market downturns. Advanced risk management capabilities. NEOS is the leadership. They have the leadership in the market for this. And they're bringing in two very, very strong people to bring in some, decades of experience from firms like the Harvest Volatile Management and the Horizons ETF Management Group. Yield max failure. Well, we can have a whole nother video on why yield max has failed and what they didn't do. But quickly, lack of experience in managing risk during market downturns. A lot of the funds that yield max uses went through title. They're just, they're not doing what we need them to do. They failed to maintain NAV stability in the volatile markets. And complete collapse in 2025 due to risk management failures, the inability to handle sudden volatility strikes. So I really tell you the difference between the NEOS deep experience in option management and significantly reduces the risk. But I'm telling you now that with leverage, it's always there. So when people start comparing this to yield max versus NEOS and what NEOS yield max has done, you got to give credit to where credit's due, and that's NEOS's experience in this industry and in this fund. So the verdict off of this, well, it's too early to call, and I'm not going to make a call good, bad, or ugly, but it's a strategic evaluation. It's not a mistake. They're strategically looking at this and saying they're calculating the expansion. It's a well-considered expansion of NEOS's product suite and a strategic, it's not a strategic misstep. They have an idea what they want to do, and they're going to implement that into it. It's a natural evolution. It's the extension of the NEOS proven option-based income strategy into higher yield spaces. And they're reaching for more market. Hey, look, everyone wants to continue to grow. You want your portfolio to grow. NEOS wants to grow bigger as well. But it broadens their appeal to that risk-tolerant investor while maintaining core investor base. Okay, it's a new market for them to be a part of. It maintains the core principles, income generation. They're trying to generate monthly distributions with tax efficiency structure. They're going to try to continue that NAV stability. Okay, they're going to try to preserve the net assets and the value that will remain intact. And the option experience, they have one of the deepest experience in the volatility markets. So they have, like I said, they have a lot of positives going for them. NEOS is definitely a strategic move forward. And they understand where it fits and why it fits into their package. And there was another reason when they came out with their adjustments in their time frames and when they're paying out their distributions. There's a reason for it. And we're going to cover that in another video, but the reason for it that they're doing is they're putting their distributions out each and every week, 4 times a week or 4 times a month from different portfolios, is because then you can build a whole portfolio just off of NEOS. So, I come back again. I'm not going to say we have a winner, loser, either way onto this. But I'm looking to each and every one. Tell me your thoughts and your opinions onto it. But I look at my base of viewers on YouTube, and definitely our people from Patreon. Where does this all fit? And me as a retiree, and most of the people I talk to are retirees. Again, this is a tool in the toolbox that we're going to use to fix something, not rely on. So my verdict, yeah, as I said, tool in the toolbox. I'm not afraid to use it because I understand a lot of the pieces to it, but I also tell you that it's not something that's going to go into a portfolio and just sit and stay like a SPYI or a QQQI. So let me know in your comments below. I'd love to hear from you what you guys think of the new funds. So recommendations and my final thoughts, I pretty much just went through this, is cautiously allocation. If you're going to get into it, allocate in a small, carefully managed portion of your portfolio. These funds need to be maintained over all the risk parameters. Understanding the mechanics of it all, understanding the synthetic leverage. Synthetic is a word that you're not really owning anything, but you got to understand your tax implications at loss with it. And the biggest thing, you got to understand your risk management, where you're at. So this one here, like I said, sophisticated investors who understand all the complexities of option strategies, synthetic leverage, and boosted ETFs, these could be powerful tools if used properly. They could be very powerful tools if in the wrong way, if used improperly. So understand where you're at. And again, I tell you, it is retirees, careful, careful, careful. Let's give this thing 3 to 6 months to find out where we're setting and how it fits in the rest of it. I appreciate your time, and we'll see you next time.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.